And we'll try to attempt two things this afternoon. The first is to discuss actionable items to address the liquidity problems of our exchanges. Before we dive in, I want to share a few statistics from the World Federation of Exchanges about the liquidity situation on our markets. In fact, they determined that only two African securities exchanges, Egypt and Johannesburg, have liquidity ratios above 20%. And that is often the minimum required to feature in emerging market indices like the FTSE and the Morgan Stanley Index. In fact, most of our African securities exchanges have liquidity levels of below 2%, including my own Ghana Stock Exchange, where we look at the equities market and we have a liquidity ratio of about 1%, and yet on our fixed income market, we have liquidity ratios of over 120%. So for us, as we develop our equities markets, how we improve liquidity on these markets is very, very important for us.
So the assignment for exchanges really is in three ways: to increase or promote the increase in investor base in terms of diversity, and also to increase the number of issuers in our respective markets, as well as to address issues of market infrastructure in our markets. So from the Botswana Stock Exchange perspective, we have mainly focused on 4 levers. We have looked at issues of regulation, we have looked at product innovation, and we have also looked at financial education, and we have looked as well at infrastructure issues. So in terms of my delivery this afternoon, and to respond to your question, Abena, in terms of a key initiative that we have implemented at the Botswana Stock Exchange to deal with liquidity issues, I'm going to focus on education as well as our lobbying initiatives, because I feel like that's an area that we've been spending a lot of time on as an exchange. So what we've essentially done is that we have looked at the various segments that currently prevail in our markets and came up with targeted messages and ways of engaging with those segments. So if you look at issuers, for example, we have developed a business development initiative where we engage companies end to end and take them through a journey of educating them about being listed and also assisting them in terms of corporatizing through, for example, our mentorship program that has been very well received by our companies back home.
If we were to take Kenya, about 75% of the country is under 35. And they are digital natives. So I remember leaving high school and I had to do a little course called computer packages. And that course was the equivalent of giving me a passport, a visa to enter into this digital space. The people or the majority of the country today are native. They were born swimming in it. And they are to the extent that one of the things that we have to worry about as parents is dopamine addiction, where my phone has so many dings, bings, and sounds that my mind is just constantly tuned to this. So now the question becomes, how do we bring that environment into the investing space? And one of the things we see is that I need to be able, and there's a lot of discussion about day trading, which is going in within the day, but there's a rather large missed opportunity, which is swing trading. Buy today, sell in 2 days. Buy tomorrow, sell in a week. And that allows me, if I was to use my phone, to get my own dings, bings, and little shakes on the phone. And that fits very well with the environment, with this young person. So tomorrow he's getting a little ding about some betting thing that he did. The next day he's getting a little bing about EABL and that it's a good price to buy. The third day from there it's a good time to sell EABL. And so you are you're swimming in the environment that he naturally walks into. And so with robo-advisory, what you get is a system that consumes the material, the research material, the data that we must all consume. And in the case of my company, Forefront, we consume 6 years of data to make one decision. And that decision comes to the client as a bing, right? On their phone, they're they're going to a party and they get a little bing on their phone saying, I think you should look at EABL. I think you should look at Safaricom, right? And that gives the dopamine rush that you get from a gambling event. Once you have that, the only thing you now need to put in front of this person is a little buy button or a little sell button, and you're in their environment. And so if I was to give it that way, it's about capturing the imagination, attacking the emotional element, gamifying the system so that you're hitting all their dopamine levels, all their serotonin levels, and the rest. And with a bit of luck, you are off to the races. Thank you.
The situation that really made things quite nerve-wracking for a lot of foreign investors was the shortage of FX, and the FX queues that we saw in markets varied from Nigeria to Kenya at some point. However, what this has created is an opportunity where things are as cheap as they've ever been. I was looking at some data on Kenya, and Kenyan stocks are 3 standard deviations from the mean. When you compare it against all emerging and frontier markets, Kenya is priced at a complete outlier. So this is really creating a once-in-a-lifetime opportunity for people to get involved in the markets. Now, unfortunately for African markets is that in the last 4 years, the competition has gone up. And the competition for every dollar that could come to Kenya is in Asia, where you have also troubled markets like Bangladesh, for example. But you also have some super vibrant markets, like what's going on in Indonesia, Philippines. So we just have to work a little harder to sell our investment case. But certainly, there's no lack of opportunity. So I think the liquidity situation has been frustrating, but I think perhaps this is now opening us up to have a different conversation. Perhaps we should not be so focused on the foreign investors. We should be looking at the domestic investors. The Kenyan government, for example, is spending a lot of time and effort to get us to save more. Kenyan savings were in cattle and land and those types of assets that you knew where it was, but now they want us to be in financial assets. So the question that we need to ask, and it came up earlier in the day, is that are there the opportunities to invest these financial assets? And people always say no, but they are. They're there. I mean, they could have funded the expressway. They could be in geothermal power stations. They could be trading carbon credits. They could be doing all sorts of things. So I think that really is the conversation that we should be having, and the opportunity. How do we grow? Some of the stuff he's talking with the robo-advisor, that's really fascinating. How do we grow that retail investor we know is in betting and getting the dopamine from betting? How do we bring them into our market? How do we get that asset manager to avoid what we were just discussing, the Ghanaian disaster of having your bond portfolio restructured? If you talk to a portfolio investor in Kenya, they think, well, the default is never possible. I'm sure in Ghana, as we spoke about, it seemed not possible, but it was possible. So I think we all need to start thinking about how do we encourage those pools of capital to be more liquid. Within T+3, you have your money. You could have it in T+0 in some markets, in some instances. It's liquid, you can see it, no one's going to run away with it.
I strongly believe that to tackle although this has been the tough nut to crack. In fact, I've been looking at the statistics and the data on African exchanges over the last 30 years. And what I've seen is there's been tremendous progress that has been made from different angles in terms of improving the technology, improving the regulatory environment, improving the governance structure of exchanges and so on. But there's one tough nut that we've not been able to crack, and that's the liquidity issue. And of course, how do you go about doing it? I think, in my view, there are what I call the 4 Ps of the ecosystem that we need to try to get aligned, so as to be able to make some progress on that. And those 4 Ps are products, they are players, getting more players to be part of the ecosystem, they are partnerships, and then the 4th one, which is very important, is performance. Of course, for time's sake, I'm not going to go into those 4 Ps. I'm going to focus only on one, which is the performance one. And here, what we're talking about is performance from the company, listed companies or listed products level, but we're also talking about performance at the macro level. And in my case, I'm going to put a lot of emphasis, because I've been following, as you say, the markets over the last 30 years. And what I've noticed is whenever the macro environment in Africa is doing very well, those are the times when we attract a lot of interest and we manage to stimulate foreign flows, but also domestic flows. Of course, this has to be in conjunction with the performance from a bottom-up standpoint, that is, from the company's standpoint. And when we look at what has happened over the last few years, this then explains why it's becoming more and more difficult for African exchanges to attract not only global order flows from the foreign investors that we want to attract, but also, as you mentioned, we are now even grappling in terms of getting the local investors to be very active. And to highlight what the point I'm trying to make, I will take the case of Mauritius, but also of a few other jurisdictions within the continent, where the investor today has a million choices when he's trying to see where to put his money. A million choices, meaning that he's sitting on the beach in Mauritius, and through his iPad, at the click of a button, he can transfer money into the shares of NVIDIA, of Microsoft, and of course he's comparing those companies against those that are listed in our exchanges, and he's making his choice on what is the best risk-adjusted return that he's expecting to get from those investments. And this is where I believe there is the company performance level that I've talked, but there is also a very important thing.
Last year, we commissioned a study at the African Development Bank. We work with ASEA to look at the competitive landscape of African capital markets, especially looking at African stock exchanges, right? So the study basically was to identify those factors that were making African capital markets to not be competitive. And then we worked with a team of international consultants who are very experienced in this space. They sampled more than 100 respondents, looked at more than 10 markets on the continent, spoke to investors both locally and internationally. They spoke to issuers also on the continent and those outside the continent. And one common theme as regards factor that was impeding competitiveness of African stock exchanges was liquidity. So it appeared like all 4 boxes. But it was not just liquidity, it was listing process timing, it was listing cost. There was a lot of mention of currency convertibility and then the exchange rate fluctuations. I think Marty mentioned some of the issues you've had in some of these markets this year, over the last couple of years, in North Africa and West Africa in particular also. I don't want to mention some countries. So you realize that when you look at some of those ratios that track liquidity, you mentioned one earlier, which is the average turnover to market cap. For a lot of our markets, it's between 0 and 10, which is very, very low, right? If you look at market cap to GDP also, for developed countries, it's usually more than 100. For a lot of our markets, maybe bar 1 or 2, it's less than 20%. So, and this brings me to your question on the AELP. When the AELP was envisaged, and we worked with this African Development Bank with ASEA, The whole idea is to promote cross-border investment flows, and it was good to listen to what the chief guest, President Ruto, mentioned earlier on this morning. So if you look at just the broad objectives of AELP, it should normally be doing that, promoting cross-border investment flows. There should be cross-listing. There should be IPOs happening. There should be innovation, creating new products for these different markets. But I would say over the last couple of years, I mean, AELP is now in phase 2, 7 exchanges in the first phase. Phase 2 targets going to 15 exchanges. I'm happy to say that Ghana, Botswana are coming on in phase 2. So there's been some achievements. The platform is there. There was a live trading today. There was a previous live trading until sometimes end of last year. So there's a lot of work going on in that regards. I think now that the platform is there, what really we need to start seeing is how then can there be more liquidity, more flows. And I would like to mention that if you look at the supply side of capital on the continent, right, you look at pension funds, you look at sovereign wealth funds, or you look at insurance companies, the AUM, asset under management, is close to $2 trillion, right? If you look at the market, even under AELP, phase 1 and 2, market cap is about maybe $1.5 trillion. A lot of the AUM of institutional investors, it's in sovereign bonds, right? So we need to start thinking of how we can get some of that money to flow into the stock exchanges, perhaps through the AELP.